we're buying some of the future value of the property at a discount. It's effectively the liquidity premiums.
You could access the equity in your house, pay off those credit card debts. Effectively, if it was a 29% interest rate you're paying to the credit card, that's like you going and making 29% on money that you didn't even have access to before you learned about Quantum RE and Matthew. What's going on, everybody? I'm Chris Naugle, your host, and welcome back to the show. Today, I've got somebody I've known for many years, Matthew Sullivan from Quantum RE, and what we're going to talk about is something incredibly unique, something that, from my standpoint, I've never seen before, something I've never even thought about, and that is this. Let me frame it up this way, and then we'll dive into a little bit about Matthew and how he came across this idea. But all of you understand real estate, right? You know, it's one of the greatest investments on earth. And all of you understand that the best way to make money in real estate is buying at a discount. If you can buy your primary house at a 30 to 40% discount, you're psyched. If you're a real estate investor and you buy into an apartment complex 30 to 40% under the value of that property, you're pretty happy, right? You're thinking to yourself, I'm in the money. Well, what we're going to talk about today is a very unique strategy, a very unique way to do exactly that, but without all the mundane issues of tenants and toilets and termites and all those things that come along with physically owning the real estate. I know some of you understand that. And then we could add lawsuits and trip and falls and contractors and building inspectors. And okay, I'll stop there. But you get the drift. But what if you could get all the benefits of the discounted price without having to deal with any of those? Well, that's exactly what we're going to go into. So before we do that, let's take a step back. Matthew, welcome to the show.
Chris, thank you for having me on. It's a pleasure to be here again.
My pleasure. Well, Matthew, I think when we get into this, this could get to be a very complex discussion with the inner workings of how this works. I mean, you and I understand that just because of our involvement in the Wall Street-ish, world, and we understand how all this stuff comes together. I've never seen somebody do what you guys have done, but let's just take a step back just with you and, how did this all come to be? How did you get into this? And what did you do prior to Quantum RE?
Great. Well, first of all, I mean, Quantum RE, what we do at Quantum RE, I think it's quite important just to establish that, and then we can sort of go backwards and figure out how we got there. But what we do at Quantum RE is actually quite simple. We provide liquidity to homeowners who have lots of equity, and we do that without debt. So we enable them to unlock some of the equity in their homes without having to borrow money. So they don't have any interest or monthly payments, and they don't have to jump through all of the sort of same challenges that they have if they want to borrow money.
So Matthew, real quick, just for the audience. So it's a HELOC, so a home equity line of credit, but without debt and without monthly payments. That's
a good way of describing it. It's
simple.
Yeah, it's a way of actually unlocking your equity, because your equity is an asset, and the only way that you can currently unlock that equity or get your hands on your equity is by typically borrowing money. Now, you can do that through a cash out refi, or you can get a home equity line of credit. But essentially, they're all the same sort of thing, because what you're doing is you're going to someone and borrowing money, and you're securing your loan by giving them a lien on your property. What we do is something very different. We don't lend you money. We invest with you in the same way that people invest in companies. We invest with you as a homeowner, and we say, here's some capital, here's some liquidity, but in exchange for that, you're going to give us a share of the value of your property when you sell it. So in other words, you don't have to pay us anything now. You don't pay us any interest. It's not a loan, so there's no monthly payments. But when you sell your home, give us a share, and we'll agree what that share is today. And that share doesn't change. So it's a percentage of the value of your property. So when you sell it, make sure that that percentage goes to us. It's very similar to when you buy shares in a company. So you buy shares at a certain price, and then hopefully, that company does well and goes up in value. You've still got your shares. You've still got that same percentage of the company. And then you can sell your shares at a future point, and hopefully the value of the company's gone up. So the value of your shares has gone up. So it's a very similar sort of thing. What we're doing is we're enabling people to sell effectively some of the equity in their home to people that want to get exposure, as you said earlier, to residential homes without the problems of actually owning those homes.
Here's the funny thing. And I think, and I know you speak at our 3-day virtual events, we do those almost quarterly, but so I understand this, but here's one of the things that I think a lot of people get hung up on. They get hung up on this future vision of the equity in their house. So here, let me put it this way to the audience that's listening to this. If you had a house today and it's worth $500,000, great, right? And maybe you only owe $300,000 on that house. So you've essentially got effectively $200,000 in equity at today's valuation. And what people want is they want to get that equity out of their house because they want to use it to pay down debts, pay off car loans, or whatever they want to do with it. Hopefully they're smart with the equity. But that's a beautiful thing. They get to use the hidden money that's literally locked up in their walls, the equity in their house, so that they can go make more money with it or make their life better. But here's the thing that I always get perplexed when people people start getting nervous about working with you is what you're doing is you're basically taking and you're investing with the homeowner for a future value or a future appreciation of that house. So if the house is worth 500 and they owed 300, there's 200,000 in equity in which your company would help them unlock some of that equity with no debt and no monthly payments. That's the first part. And then what the homeowner is agreeing with you is that when their house goes up, and we'll cover the downside, but when their house goes up in value, so it goes from 500 to 700,000 in the next 10 or 10 years, we'll just use. So now they've got that future appreciation. What the homeowner is doing and what you're doing with the homeowner is you're agreeing to share in a portion of that future appreciation that doesn't even exist today in exchange for them getting some of the equity they have today to use to make their lives better or do all those things. Am I explaining that properly?
That's it. In fact, in some ways, it's actually more simple than that, because what we're saying is in exchange for some money that represents a certain percentage of the value of your property today, you're going to give us a certain percentage of the value of the property in the future. So it's not even a share of the appreciation. We just say, like, in exchange for 10% of the current value today, you'll give us, let's say, 19% of the value of the property in the future. So we're buying some of the future value of the property at a discount. It's effectively the liquidity premium. So in exchange for cash today, you're selling us an asset, which is some of your equity, but you don't have to actually transfer it to us. We don't want to be an owner. It's really, when you sell your property, make sure that 19% of the value of your property at that point goes to us. So if the property goes up or goes down, that's, we don't know what's going to happen. So if the property goes down in value, it's still 19% of whatever it goes down to. So we could make a loss, potentially. So we don't have to worry about calculating the share of the appreciation or anything like that. It's just a straightforward trade. So, it's like the sort of present money calculation where the value of money today is worth more than the value of money in the future.
I love that. You took the words right out of my mouth. Yes. I was going to say, the beauty of this whole thing is your dollars that you have today are the most valuable they will ever be. In the future, they'll be weaker because of inflation and it'll be taxed at a higher rate. But these are your most valuable dollars today. And what people are doing is they're only exchanging or trading future value that doesn't even exist today to get the most valuable dollars that they have unlocked from their house. That to me, that says it all. I mean, that's phenomenal.
Yeah. And it's great because then as a homeowner, you can do lots of things with that money because you've actually got it in your hands and you don't have to make any monthly payments. And that's really important because if you unlock, say, $100,000, you can actually do something quite useful with that from an investment perspective. It could be a down payment. You could borrow you could buy another house with that, for example. Or what a lot of people are doing is they're paying off credit card debt. Now, credit cards charge 25, 29, 30%. If you've got credit card debt and you're paying 30% interest, then that money is effectively giving you a 30% return. I mean, all this sort of stuff.
Oh, 100%.
And so it's what you're doing, but you're actually taking money from somewhere that may not exist in the future. And that's the really interesting thing from a homeowner's perspective, because you're tapping into this sort of equity and then selling it, but you're selling something that may not exist. If your property goes down, then that equity's gone, but you still got the money, and you're not on the hook for it. So it's not like a loan where you owe that money irrespective of whether your house goes up or down. So you can't go underwater with these types of agreements. So that's really useful from a homeowner's perspective. But some homeowners do struggle with that because they want to hang on to this idea of having equity in the future.
And that's all it is a falsified reality of self within their mind, because they're putting a valuation on something that doesn't exist today. And they're foregoing the things that do matter today, like if they've got a bunch of credit card debt. Now, for all of you listening, I want to just give you a couple stats. If you've been paying attention right now, 2023, the debt load on American households is the highest that it's ever been. The credit card debt in American households is the highest that it's ever been, and it's rising rapidly. Do you all know why? Well, look at the price of eggs. Look at the price of everything. It's inflation. And people are still spending because they have to and because they want to and because they're still employed, but they're not spending money that they earn. They're spending credit card money. They're spending debt. They're increasing their debt loads. And that's a very dangerous situation, especially if we're going into this recession, which we're already in. We go deeper into it. Debt will be the single burden that sinks American households and American families. So what we're talking about here is if you could access the equity in your house, pay off those credit card debts effectively. If it was a 29% interest rate you're paying to the credit card, that's like you going and making 29% on money that you didn't even have access to before you learned about Quantum RE and Matthew. So think about that for just a second. And then if you're super smart, you would take and add up all the credit card monthly payments that you were paying to someone else's bank. And when you pay them off with this money that's trapped in the walls and in your attic right now, so you pay them off, if you were really smart, you would take the amount that you were paying them and you would just put that into an account, a bank account, a money market account, maybe one of those specially designed and engineered whole lives I always talk about, because realistically, that's money you're giving away. And it's money now that you get to recapture and recycle for yourself. Like, that is so important to understand, because that is the fastest, simplest way to wealth. And there's no risk to it, zero risk, because it's money you're just giving away that you recapture. There's no risk like the stock market or anything else. So Matthew, now that we went into that, I think this is, I get so excited every time I hear you talk. Now I'm even more excited because we got another level that we're going to get into in a second, because now that people understand what it is Quantum does. But before we go into this next new level that's really exciting for investors and in ways that people can do what I said earlier, they can literally have access to homeowner or to homes, residential homes, at a 30 to 40% discount. Conceptually, but how did you learn how to do all this? Because this is complicated stuff. What's your background?
Well, it's really, I stumbled across this asset class about 5 years ago when, in fact, more than that, probably about 6 or 7 years ago, when I was in the very early stages of one of the earlier ventures that I set up, which was a real estate crowdfunding company. And one of the biggest challenges with, sort of trying to put deals together is that they can be very complicated and very expensive to manage. So if you're trying to offer lots of individual real estate deals on your crowdfunding platform, the problem is each one of those deals needs to be managed. And so you need lots and lots of people and lots of money, because if one of those deals starts going sideways, you've got to try and figure out how to fix it. But this asset class is much easier to grow and scale, because each home is managed by the owner. So you don't have to worry about, tenants and fixing them and rent rolls and all that sort of stuff, because the owner is the steward of your asset, and they're motivated to look after it because it's their house. And also, you don't have to worry about competing with other people to buy a house, because you're not buying homes that are for sale. You're investing in homes that are not for sale. So it's an entirely different sort of bucket, where you can actually, work with the homeowner because your interests are much more aligned. So this sort of 7 years ago was still very much in the early days as an asset class, and since then it's grown like topsy, really. So over the last 18 months, I think we estimate about $1 to $1.5 billion has been invested in these types of agreements. They're called home equity investments. We've seen half a dozen companies pop up and grow really quickly, and they're funded by some pretty serious VCs who see the prospect of this type of asset class. But really, that's how I came across it. And then 5 years ago, we set up Quantum, because the biggest problem with this asset class is apart from the fact that not many people understand it, is it doesn't have the same attractive components as yield. So it doesn't throw off cash. And most investors say, well, I want my monthly cash flow. So what we thought the way to solve that problem is actually to create a marketplace. So you could invest in these home equity investments. And then if you wanted to get an exit and didn't want to wait for the homeowner to sell or the homeowner to pay you back, you could actually sell your investment in a marketplace, in the same way that if you bought a piece of real estate, you could sell your interest to someone else and get some liquidity that way. So that's why we set up Quantum and the marketplace. And that's and my background before that for quite a long time has been entrepreneurial and technology and finance. I spent a few years working with Richard Branson in the UK, and just saw how these markets that are hidden could suddenly explode. And I think that's what we've got here with this ability to tap into home equities. I think the figures are something like $25 trillion worth of equity is locked up in people's homes.
Wow, that's phenomenal. And I just love this, because it's, number one, it's technology. Number two, it's just something that most people aren't even thinking about, but they need, and
yes.
you're solving a problem that people don't even know they have right now. And not only that, even if they do know they have this problem where they want to unlock their equity, a lot of people can't because of credit scores, or
exactly.
Banks just won't approve them for a home equity line, or the people just don't want another monthly payment for accessing the equity in their house. I mean, there's so many variables that prevent people from using the equity in their house. But how much, again, let's just repeat that. How much of, the home equity of people's homes, how much does that account for people's?
I think that the figure for last year, I think it's $23 trillion.
That was a T, right? Trillion?
Yeah. It's a whole bunch of zeros at the end. And I think over, I'm not sure if the figure's current, but I think the latest figures, there's a company in California called Atom that does this report called the the homeowner equity report. And over half the homes in the US at the end of the year were equity rich. And what that means is over half of the properties, the owners had more than 50% equity. So, I mean, we all know that house prices have rocketed up over the last couple of years. So there's all this fantastic equity sitting there. But as you rightly say, for many people, if you go to the bank, you're not going to get the loan that you want because you don't meet the criteria. But this is where it's really challenging for people. Even if you do get the loan you want, the price for that loan is probably twice what it was when you took it out before. So if you've got a mortgage that you want to refinance to get some cash, you're probably going to pay twice as much for the same amount. Just to refinance your existing mortgage, you're probably going to pay double the interest rate. So you end up taking 5 steps backward, and layering yourself up with costs just to get a little bit of extra cash. So that's a no-go. So you've got all of these sort of things that are happening at the moment that make it really difficult for homeowners to tap into that equity, but it's still a really valuable asset for investors who want to be able to participate in the potential future appreciation of your home.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up. Oh, I love it. And you're right. Just so you all know, if you haven't been paying attention, we just did this last week for this weekend's 3-day training. We looked at what home equity lines of credit are costing, and we went across the country, nationwide, and we just did an average. So the average, and I'll just give a range, is between 7 to 9% right now to get the equity in your house on a home equity line. Now, just to put that in perspective, about a year ago, or maybe even 2 years ago, that was about 2 to 3%. And, if you were to refinance your house, which I typically don't understand why people do refinances and pull their equity out, because the bank makes all the money in the first 7 years on the velocity and the way that they amortize these loans. So you're losing all the closing costs when you do that. But, a mortgage right now is, I think the lowest you're going to find is in the high 5s, but it can go up to 7%. Depending on your credit score. So you're right. I mean, the cost for just getting the equity out of your house, whether it's cash out or home equity line, has, well, in some cases, I mean, almost tripled now.
Yeah.
Which is crazy that it's happened so quickly. But that's what happens when the Fed doesn't pay attention, ignores the fact that we got runaway inflation, and prints $5.1 trillion. No pun intended, but they screwed up. And now they're backpedaling very rapidly and raising interest rates very rapidly, which is affecting all of America. But you provide the solution. So now let's segue into the next part. And also, for any of you that notice the little black critter sitting on my desk, if he is showing up, this is Lazy Cash. He's part of the show. There's no way for me to keep him out of the show. So just get used to him, and he'll pretty soon probably have his own podcast going. But let's transition into this new exchange, this new marketplace that you're creating, because it's great for homeowners. But what if somebody was an investor and they had some money and they didn't want to invest in Wall Street? They wanted a non-correlated asset. They like real estate. They want something protected, something more secure with very low downside. Like, you've solved this problem for them now too, or will soon, I should say, because you're almost out of beta. So let's talk a little bit about what this looks like for the other side of the coin.
Yeah, great. And you're right. The other side of the coin is, we've been talking about getting liquidity to homeowners, solving a problem for homeowners and what they can do with the money. But the big question is, where does that money come from? And it comes from investors. It comes from investors who want to make a return on their capital. And the way they make a return is that discount we talked about earlier. So in exchange for liquidity to the homeowner, the investor gets a real estate asset, which is a share of the potential or the future value of your property at a discount. So that asset is actually quite valuable to real estate investors, because they're able to get a return which is secured by a lien on your property. So it's a properly structured deal at a discount to the current market value. And that's really important for the investors, because if the value of your property goes down, that discount is a cushion, which means that your property can go down by 10% a year for 3 years, and the investor can still make a positive return on that investment. So it's for those of you that know about options, it's an in-the-money option, effectively.
Love that.
And that's really interesting for homeowners, because for investors rather, because they get a real estate asset which is protected against the market falling. So most investors today are saying, the problem with real estate is we think it's going to go down. Well, that's okay, because there's so much discount built into this agreement, it actually caters for that and protects you against that market fall, to a certain extent. So what our marketplace does is it enables smaller investors to invest in this really interesting, compelling real estate asset class. Because right now, there's billions of dollars going in, but guess where it's coming from? It's coming from institutions and pension funds and other types of institutional investors where minimum ticket sizes are typically $100 million. It's a very closed shop, so it's a real institutional play. And you cannot get exposure to this asset unless you are part of that group. It's like, like any of these sort of, it's like trying to buy, credit default swaps from Goldman Sachs. Okay, they're not going to sell you for, you've got to buy, millions of dollars worth. So what our marketplace does is it takes each one of those home equity investments, converts it into a security using US securities regulations, and enables investors to buy pieces of each one of those individual home equity investments. And they can sell those investments at a point in the future that they choose for a price that they decide. Now, the caveat is that we've launched that platform in a beta mode, as you say. In other words, it's set up, it's only available to accredited investors at the moment, but we are working to change that by a new type of filing called a Regulation A+ filing, which we're going to be submitting very soon. And that will, we hope, by the middle of this year, open up that platform so non-accredited investors can buy into the equity of owner-occupied homes using securities. It's a very well-known, well-understood, well-protected process where we use highly compliant structures and broker-dealers. And most importantly, they'll be able to sell those securities as well. So once you've bought your shares in some of these properties, and you can pick and choose which properties you want in the areas that you like, you can hold them for as long as you like. And if you think, or if they've gone up in value, you can potentially sell them to another willing buyer in our marketplace. And that then creates this liquidity for something that has been illiquid since time began, which is the equity in single family homes.
Wow, that's wild. So one other thing too, Matthew, if you could, because some people may not understand accredited and non-accredited. Could you just give them a quick 30,000 foot view of what an accredited investor is, and then a non-accredited is just everybody else?
Yes. So the test, the SEC test, is $200,000 worth of income over the last couple of years, with the prospect of that remaining the same for the future, for this year, or $1 million worth of assets, excluding your primary residence, or if you have certain securities licenses, such as a Series 7 or a Series 63, I think. So in other words, if you're an investment professional, or you can be a qualified investment professional, which means that you've got a certain amount of assets under management. But for most people, the test is $200,000 a year income, $250,000 a year joint income, or $1 million worth of assets, which don't include your home. And that's actually not a terribly large percentage of the investing population. Most people are non-accredited. In other words, they don't have that income. And that means that most types of private placements and real estate investments that are not mainstream, in other words, alternative real estate investments, are not available to these people because they're not accredited. But there was a change in the law about 6 or 7 years ago under the Jobs Act, which meant that certain issuers, if you go through a particular process, you can issue your offerings or your shares to everybody. So those people can be accredited or not accredited. And that means you're really opening up this opportunity to everybody. So rather than it being just the preserve of institutions or just the preserve of people with, large, deep pockets or members of the local country club. This type of investment becomes available to everybody, which we really want to happen because we think everyone should be able to invest in the equity in people's homes. And also we think that these people should be able to benefit the homeowners. So it really is a play or a democratization. I hate using that word, but it really does open it up to everybody. And I think that's what should happen.
Well, shameless plug. So back a while ago, we also have a technology company, Private Money Club, that we created, which is, I always call it the dating site for money. It solves a problem for people with money and people that need money, kind of much like what you've created. You're solving a problem for people that need or that have money, like we just talked about this exchange. And you're also solving a problem for people that need money by allowing them to tap into the equity in their house. So the two are very, similar. And what we're doing in Private Money Club is, by the end of the year, we're partnering in an RIA, a registered investment advisor, which will give us the ability to then have security or security-like investments offered on Private Money Club. And we've also instituted a certification program and a badge-like program. So you can get different badges. And one of the main badges in the platform is going to be an accredited badge, which all you do when you create your profile, you will self-verify as an accredited investor. So you'll basically read through all the documents, check some disclosure and say, yes, I'm an accredited investor. And once you verify that, which will be all stuff created by our SEC attorneys. And then once you do that, you get a badge that says accredited investor. Now, once you get that badge, it opens you up to another level within Private Money Club. And that level is an accredited investor page. And you can go in and you can browse through all the investments that would be available only to accredited investors, things like syndications, private Reg D funds, Reg A funds, Reg A plus funds. But the Reg A plus fund that you're going to be creating, once you're approved for that, that could be offered on the main page because it's a non-accredited investment. So Private Money Club might be a really good source, folks, for you to get access to what you're talking about here, Matthew. And it's kind of interesting because, I know we talk quite a bit, but we never really bring the two things together. But it just snapped and clicked for me that, number one, this exchange would fit perfectly in the accredited investor page. And then it might very soon fit very nicely into the basic forum style page where you could just post this up and people can get information by going to your website. So folks, if you're interested, we're going to give you, Matthew's website here and we'll put it in the description, but also you'll, by the end of the year, you'll be able to check this out on privatemoneyclub.com and you'll be able to have access to these type of investments right there.
Without the $100 million minimum ticket price.
Bingo. Yes.
Yes.
Bingo. That's the beauty. And the Reg A plus part, really does open it up to the entire investor population, if you really think about it, because there's really nobody off limits, where the accredited, as much as I'm so deep into it that I feel like most of the people we're working with are accredited, but I think we're missing the majority of the market. And I think something like what you're creating and what we're going to be developing with the Private Money Club are going to be just a really good way to bring these type of non-correlated asset classes to the masses, because the masses really only know 401ks, mutual funds, ETFs, and maybe they get themselves a brokerage and invest, directly in stocks. But I'm going to tell most everybody, I don't need to tell, that ain't looking so pretty right now. Like if you're looking at your account statement, the value, well, there's a big red number there for many of you and a big negative number. And this really gives you the ability with something like this to have non-correlated asset classes that really, like, if you think about it, Matthew, really only the wealthy have had access to things like this in the past.
That's it. That is exactly it. And that's the great thing about the sort of the regulations and the change in securities laws with the Jobs Act is, and we've seen, not to bang on about it too much, but just the amount of money that has been invested over the last few years in these new online real estate platforms is measured in the billions. And it's been a huge success. And it really does exactly what you just said, which it enables people that otherwise would be prevented or prohibited from investing in these types of assets. It opens up these assets to them. They're not lower class or lower quality assets. They are highly attractive, compelling, well-structured, well-performing real estate assets that are simply only available to institutions because the people that work, the people that offer them, don't work with smaller investors. So you're taking something using those securities regulations, and you're creating pathways into assets that previously were not available to those people. And that I like that sort of Robin Hood type approach. Making things available in a properly structured, properly regulated, compliant way. There's no, there's a lot of sort of stuff behind the scenes to make sure that everything is done in a completely compliant way, which is important because it protects the investors. But you get to see stuff that you would never see without all of the costs associated with things like real estate investment trusts and other structured vehicles, where you have layers and layers of management, taking money out before it hits the investor.
Exactly. One of my favorite artists of all time is the Bob Dylan, the late Bob Dylan, and he had a song, and it's "The Times Are a Changin'." And folks, with this podcast and what Quantum RE and Matthew is doing, along with what we're doing with Private Money Club, I can sincerely tell you, when it comes to investing opportunities, the times are a changing. So Matthew, now that we've kind of explained the two sides of the coin here and what Quantum does and what's coming in the near future, how do people learn more about what you've created? And is there, if they are accredited, by the SEC standards of accredited investors, and they want to check the beta out, where would they go?
Great. Everything's on the website. So it's quantumre.com. That's QUANTMRE.com. So there's two sides to the website. There's a side, if you're a homeowner, you can find out how much capital you could unlock, and you can get to see how that works. But there's basically two buttons. One says I'm a homeowner, and the other one says I'm an investor. So if you click on the I'm an investor button, you can register an account now. If you're an accredited investor, you can go in, you can see the platform, you can see the assets on the platform, you can read all about we've got about $1 million worth of assets on there right now. There's lots of other information on the site, downloadable ebooks. There's lots of other sort of videos, podcasts. We've been around for a number of years. So, you can see me getting sort of older and fatter as these, podcasts sort of progress over time. And you can also contact us, phone calls, emails, all the contact details are there. So, go take a look, and we'd love to hear from you.
That's fantastic. And folks, we're going to put that website right in the description. So if you didn't catch that, quantumre.com, it'll be in the description. Just click the link, check it out. And it doesn't matter what side of the coin you're on. Maybe you're looking to unlock that equity. Well, click homeowner, and there's a calculator that will help you figure out what you potentially could get out of the house, based on your numbers that you put in. And then the investor tab, where you can learn more about this exchange and what's coming, where you can take advantage of this incredibly unique asset class that might work very well for you and your family. So folks, I hope you've enjoyed this. Matthew, thank you so much for your time today.
Thank you, Chris.
And Cash, thank you for making an appearance. It was always a pleasure. You brought so much to the show. All right, folks, with that being said, we're going to bring this episode to a close. Thanks for joining us. Make sure you check out our other episodes on YouTube or anywhere else you can find a podcast, because this show, the Money School Podcast, is getting bigger. And thank you all for your support. We'll see you next time.